In 2021, a carton of eggs cost about $1.50. By 2023, that same carton cost over $4. Then something strange happened. Inflation slowed down. The news said prices were cooling. Central banks declared victory. And the eggs stayed at $4. Not $3. Not $2.50. $4. Here's the part nobody explains to you. When people say inflation is coming down, they don't mean prices are dropping. They mean prices are rising more slowly. The carton isn't getting cheaper. It's just getting expensive at a gentler pace. That distinction sounds small. It isn't. It's the difference between a system that heals itself and a system that never lets you catch your breath. So today we're going to answer a question that sounds simple but almost nobody can actually explain. Once prices go up, why do they almost never come back down? And who benefits from the fact that they don't? Why this matters now? This isn't abstract economics. This is your rent. Your grocery bill. Your sense that you're working harder and somehow falling behind. Over the last few years, wages went up. On paper, that sounds like good news. But prices went up faster and stayed up longer. The gap between what you earn and what things cost hasn't closed. It's just stopped widening as quickly. Governments call this returning to normal. But normal, in this case, is a permanently higher price for everything you already own less of. To understand why, we have to look at what actually happens inside a price after it rises. Because a price isn't just a number. It's a decision, made by thousands of businesses, that gets locked in and almost never revisited. How the system actually works. Let's start with the boring, mechanical truth. A price is not a reflection of cost. It's a reflection of what a business believes it can get away with charging, adjusted for cost. When costs rise, businesses raise prices. That part is intuitive. Fuel gets more expensive, so shipping gets more expensive, so the product on the shelf gets more expensive. Fine. But here's what almost nobody talks about. When costs fall back down, businesses don't reverse the price. They just stop raising it. Why? Because customers have already adjusted. The pain of the price increase has already happened. Nobody is rewarded for lowering a price the customer has already accepted. There's no applause for generosity in a spreadsheet. Economists actually have a name for this. It's called price stickiness. Prices are sticky going up, and even stickier coming down. Think of it like a ratchet on a socket wrench. It turns easily in one direction. In the other direction, it locks. Now scale that ratchet across an entire economy. Every company, every supplier, every landlord makes the same quiet calculation at the same time. Raise it when you can. Hold it when you can't raise it further. Never, under any normal circumstance, walk it back. Multiply that by millions of individual pricing decisions, repeated every quarter, for years. That's not a conspiracy. Nobody needs to coordinate this. It emerges naturally, because it's simply the more profitable behavior every single time. The hidden mechanism. Here's where it gets uncomfortable. This isn't only about corporate greed, even though greed plays a role. There's a deeper mechanism at work, and it lives inside the definition of inflation itself. Inflation is measured as a rate of change. It answers the question, how much more expensive is this basket of goods compared to a year ago? When that number falls, headlines say inflation is beaten. But a falling inflation rate does not mean falling prices. It means prices are still rising, just less aggressively than before. For prices to actually fall, you would need something called deflation. And deflation is treated by almost every central bank on earth as a 5-alarm emergency. That's the part that should stop you. Falling prices, the thing that would actually relieve you, is considered more dangerous by policymakers than prices staying high forever. Why would anyone fear cheaper goods? Because deflation breaks the machinery of debt. If prices fall, people expect them to keep falling, so they delay purchases. Businesses sell less. They lay off workers. Debts, which were borrowed in yesterday's more valuable dollars, become brutally hard to repay with today's shrinking incomes. The whole system can spiral. So central banks target a small, constant, positive rate of inflation, usually around 2% a year, forever. Not zero. Not negative. Slightly positive, permanently. Read that again. The official goal of monetary policy is not stable prices. It's prices that always rise, just slowly enough that you don't panic. That's the quiet mechanism. Your economy isn't built to protect the value of your money. It's built to protect the system's ability to keep functioning, and a small steady erosion of your money's value is considered an acceptable, even necessary, cost of doing that. Hype versus reality. Here's the hype version of the story, the one you hear in press conferences. Inflation was a temporary shock. Supply chains got fixed. Rates came down. The economy is healthy again. Here's the reality. The price level itself, the actual dollar figure on the receipt, almost never returns to where it started. Economists don't even try to promise that. If you ask a central banker directly, will prices go back to where they were before this inflation spike, the honest answer is no. That was never the plan. The plan was only ever to slow the climb. Not reverse it. There's a quiet irony here worth sitting with. We built an entire vocabulary, cooling inflation, disinflation, soft landing, that sounds like relief. But translated honestly, every one of those phrases means the same thing, prices are still going up, just more politely. It's a bit like being told your car is still speeding toward a wall, just not accelerating as fast as it was a moment ago. Technically true. Still headed for the wall. Who actually benefits? So if prices never come back down, someone has to be on the winning side of that. And they are. Debtors benefit from inflation, because they repay old debts with money that's worth less than what they borrowed. Governments are, structurally, some of the largest debtors on the planet. A government carrying trillions in debt has a quiet, built-in incentive for prices, and therefore its own tax revenue in nominal terms, to keep rising, while the real value of what it owes slowly shrinks. Asset owners benefit too. If you already owned a house, stocks, or a business before prices rose, that asset's price rose right along with everything else. Your net worth, at least on paper, climbed. But if you're paid in wages, and your wages adjust slower than prices do, which they almost always do, you experience the opposite. You're not participating in the ratchet. You're being ratcheted. This is why the same inflationary period can be described by two people, both telling the truth, in completely opposite tones. The homeowner says the economy is doing great, look how much my house is worth. The renter says everything is unaffordable, and it's not getting better. They're both right. They're just standing on different sides of the same mechanism. Zoom out, the bigger implications. Zoom out far enough, and this stops looking like an accident of markets and starts looking like a structural feature of how modern economies are built. Every currency you know, the dollar, the euro, the pound, is designed to lose a small amount of value every single year, indefinitely. Not because policymakers are careless. Because the alternative, a currency that holds or gains value over time, would encourage people to hoard cash instead of spending or investing it. A shrinking currency, ironically, is what keeps an economy moving. But that design choice has a cost, and the cost is paid unevenly. It's paid by anyone whose income doesn't rise as fast as prices. It's paid by anyone who doesn't already own assets. It's paid, disproportionately, by exactly the people who feel like they're falling behind and can't quite explain why. Over decades, that small yearly erosion compounds into something enormous. A basket of goods that cost you $100 20 years ago might cost $200 today. Not because anything about that basket physically changed. Because the ruler you're measuring it with has been quietly shrinking the entire time. So the next time a headline tells you inflation is cooling, ask yourself what that phrase is actually promising you. It isn't promising your grocery bill will shrink. It isn't promising your rent will drop. It's promising the climb will feel a little less steep than it did last year. The prices you're paying right now, the ones that felt shocking 18 months ago and now feel normal, aren't going anywhere. They're the new floor. The next increase will be built on top of them. Which raises the real question, the one worth sitting with after this video ends. If the system is designed so prices only ever move in one direction, what exactly are you supposed to do with the years you spend earning money in the other one?